Let me ask you something nobody ever asks. You wake up every morning, you fight traffic, you sit through meetings, you come home exhausted, and you do it again tomorrow. That is you working for money. Now, let me ask you this. What is your money doing while you sleep? Right now, if your $10,000 is sitting in a bank savings account, I'll tell you exactly what it's doing. Absolutely nothing. 1% interest per year. That's $100. That's less than $9 a month. Meanwhile, inflation is quietly stealing 3.3% of your purchasing power every single year. You are working 10 hours a day. Your money is working zero. That ends today. Because in the next few minutes, I'm going to show you the exact 3-layer system to take $10,000, money you already have, and turn it into a machine that generates cash while you sleep, while you watch Netflix, while you're on vacation. No day trading, no stock picking, no finance degree required. Just a simple system and the discipline to start. Let's go.
Before we get into the exact system, we need to destroy 3 lies you've been told your entire life. Myth 1. Saving is safe. Investing is dangerous. Here's the cold truth. The U.S. inflation rate right now is 3.3%. The average savings account pays 1.9%. That means every single year your money sits in the bank, you are losing 1.4% in real purchasing power. Over 10 years, your $10,000 silently shrinks to $8,700. Tell me, does that sound safe to you? Saving isn't safe. Saving is just losing slowly. And slowly is the most dangerous way to lose, because you don't feel it until it's too late. Myth 2. You need a lot of money to start investing. Wrong. $10,000 is not just enough, it's the perfect starting point. Here's why. At a conservative 6% annual return, $10,000 generates $600 a year. That's $50 every single month automatically while you do nothing. $50 doesn't sound life-changing, but that feeling, seeing money appear in your account that you didn't work for, that changes everything about how you see money forever. Myth 3. Investing means staring at charts all day. That's trading, not investing. Passive investing means you set the system once and let it run. Like a washing machine. You pick the cycle, press start, walk away. Come back when it's done. The entire philosophy of passive investing is simple. The market is smarter than you. Don't try to beat it. Just join it.
Here is the exact $10,000 allocation system. 3 layers. Simple, clean, and battle-tested. Layer 1, the safety net. $2,000, 20%. The first $2,000 never gets invested, ever. This is your emergency fund. It goes into a high-yield savings account or short-term fixed deposit, accessible within 24 hours. You might think, isn't that wasted money? No, that $2,000 is the foundation everything else is built on. Without it, the moment your car breaks down or your job changes, you're forced to sell your investments at the worst possible time. I've watched smart people destroy their entire portfolios, not because they picked the wrong stocks, but because an unexpected $800 expense forced them to sell everything during a market crash. Think of this layer as your financial immune system. You don't notice it when everything is fine, but without it, one small emergency can wipe out years of progress.
Layer 2, the growth engine. $6,000, 60%. This is where your money actually goes to work. $6,000 split into 2 simple buckets. Bucket 1, 70% into stock ETFs, $4,200. Total market index funds, Vanguard VT, VOO, or VTI. These funds own tiny pieces of thousands of companies across the entire global economy. Long-term annualized return, 8% to 10%. You're not betting on one company. You're betting on human progress. And human progress, over long enough time horizons, has never lost. Bucket 2, 30% into bond ETFs, $1,800. Bonds are your shock absorbers. When stocks crash, and they will crash, bonds typically hold steady or go up. Lower return,
3 to 5%, but they protect you from panic selling during downturns. The combination gives you growth without the stomach-churning volatility that makes people quit. Critical rule: don't invest all $6,000 at once. Divide it across 6 months, $1,000 per month. This is called dollar cost averaging, and it means you automatically buy more shares when prices are low and fewer when prices are high. You stop trying to time the market, which is impossible, and start building wealth systematically instead. Layer 3, opportunity bullets. $2,000, 20%. The final $2,000 sits in a money market fund, earning 2% to 3%. Waiting. Waiting for what? For the market to crash. My personal rule: when the broader market drops more than 15% from its peak, I start deploying this cash in batches. Not all at once, in chunks. Buying more of the same ETFs at a significant...
Part 3. 5 steps to start today. The system is simple. Here is exactly how to execute it. Step 1. Open a brokerage account. Takes 10 minutes online. ID and bank details. Zero commission ETF trading is standard now at every major broker. Step 2. Automate everything. Set up automatic monthly transfers the day your paycheck arrives. Remove human emotion from the equation completely. The system runs whether you feel confident or scared. Step 3. Pick your ETFs. Don't overthink this. VTI for total US market. VT for global exposure. A bond ETF like BND for stability. Simple, clean, done. Step 4. Rebalance every 6 months. If stocks grow to 80% of your portfolio, sell some. Buy bonds to get back to 70-30. This forces you to sell high and buy low automatically. Takes 30 minutes, twice a year. Step 5. Learn but never react. Spend 1 to 2 hours per month reading about macro trends. Never check your portfolio daily. Never trade on emotions. The statistics are brutal. Retail investors underperform the market index by 3% to 5% every year, purely because of emotional decisions. The best investment strategy is the most boring one. Buy, hold, rebalance, repeat. Part 4. What this actually builds over time. Let me show you what this system does over time. $10,000 at 7% annualized return. 10 years, nearly $20,000. 20 years, over $38,000. 30 years, over $76,000. Now add just $200 per month on top of that initial $10,000. 30 years later, over $300,000. From $200 a month. That is the power of compound interest. Einstein called it the 8th wonder of the world. After watching it work in my own account for years, I completely agree. But here's the honest part nobody tells you. You will experience crashes. In March 2020, my portfolio dropped over 30% in weeks. It felt terrible. But my bond allocation cushioned the fall. And by the end of the year, I had not only recovered, but walked away with solid gains. Your biggest enemy in investing is never the market. It's your own emotions. That's why the system exists. So when the market crashes and fear is screaming at you to sell, your system already tells you exactly what to do. Keep buying. The decision that changes everything. Let me leave you with something real. If you are 30 years old right now, earning $60,000 a year, your lifetime earning potential is over $2 million. Your biggest asset isn't your portfolio, it's you, your skills, your career, your ability to earn. So while this system grows your $10,000 quietly in the background, keep investing in yourself. Learn, grow, increase your income. Because every dollar added to your income is a dollar that compounds in your portfolio for decades. I have a close friend who started with exactly $10,000. At the same time, he invested in his skills aggressively. His salary went from $60,000 to $120,000 in 4 years.
His portfolio followed. By 38, he had over $100,000 invested and growing every single month. Same starting point, better system, bigger outcome. Here is the truth about the $10,000 sitting in your bank account right now. Every year you wait, inflation takes $140 of its real value, silently, without asking, without warning. The market isn't waiting for you to feel ready. Inflation isn't waiting. Time isn't waiting. The best time to start was 10 years ago.
The second best time is right now. Not tomorrow, not when you feel more confident, not after the next paycheck. Right now, today. Spend 30 minutes researching how to open a brokerage account. You don't need to invest everything at once. Start with $100. Start with $200. Start with whatever you have. Because the goal isn't perfection. The goal is to start. 10 years from now, you will look back at this exact moment, and you will either be grateful you started today or wish you hadn't waited so long. Your money has been sleeping while you've been working. It's time to wake it up.